This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Let me jump right into it. I have one of these fine Howard Marks memos in front of me. Howard Marks, the great investor. Howard Marks, who has appeared on this show. And quoting from his recent memo, or one of his recent memos, I want to talk about the thought process of gambling contrasted against the thought process for good investment, good trading. Now, a lot of these ideas I've written about in my books extensively, but I thought this was a great reminder, a great summation, right to the heart of the matter. First, game selection versus skill. When considering where to invest, it's important to understand both how much of the requisite skill you possess and the quality of the competition. Being a consistent winner among the best gamblers or in the most intensely competitive markets can be very difficult. Instead, your energy might be better spent looking for less efficient niches. Unfortunately, it's harder to find them than it was decades ago. Now, he's not saying it's impossible. He's just saying it's harder. Number two, increasing efficiency, the tendency of markets to adapt. In the early days of online poker, it was easy for decent players to win, and a lot of amateurs were enticed to play by seeing a newcomer win the World Series of Poker. After some time, however, the games became tougher as they attracted professional players, and the amateurs lost their money. The new, more sophisticated generation of competitors learned their predecessors' tendencies, improved on their strategies, and started beating them. In this way, changes in the arena and in participants' behavior can cause what worked years ago to not work today. Which also takes you right into trend following. Because trend following is really not trying to get into the head of anybody. It's just saying, what the hell is showing momentum? And let me follow it. And if you have that mentality, if you have that momentum mentality, you're sort of prepared for anything. You're ready for anything. You don't have to have a thesis for what's going to happen next. You are ready, rolling into the game, ready to make your move. Number three, quoting from Howard Marks' paper, circle of competence. Just because you're great at gin rummy doesn't mean you should play Texas Hold'em against a professional poker player. It's important to know your strengths and stick to them. I can't imagine any trend following trader who wakes up one day and says to himself after 5, 10, 20 years of success, you know what? I think I can trade at the speed of light today. You know what? Yeah, exactly. All this trend following experience has taught me how to day trade at the speed of light. I can now be a high frequency trader. I have that skill from 20 years of trend following. Not really. Kind of similar to this new basketball player, this great new NBA player. This guy Zion Williamson. The guy's a beast. He's like 6'7", 285 pounds. The size of an NFL offensive lineman. Now, he could probably go straight to the NFL right now and compete as an offensive lineman or a tight end and be world class with that athletic ability. But if he spends all of his time at the NBA, he specializes in that, his chances for crossing over are not as great. And he might not be the best example because he's such an exceptional athlete. He might be the guy that could cross over very easily. But most people can't. Most people can't cross over as an expert in one area immediately to the expertise in another area. It takes a lot of time. It takes a lot of hard work. Number 4, back to Howard Marks' list, not having to play every hand. There's no requirement to bet on every game or every hand. You can wait until you get a particularly attractive proposition, one that you feel particularly capable of analyzing and understanding, and where the odds are on your side. In the interim, it's better to sit out and protect your bankroll. I see this all the time. People write me with this desire to make consistent money. I want to make 2 to 3% per month. Where the fuck did this goal come from? You want to command the market to give you 2 to 3% per month. It's like somebody developed that thought without ever knowing who Howard Marks was, without ever knowing who Nassim Taleb is, without ever knowing who Warren Buffett is, or John W. Henry, or Jerry Parker, or any of these great minds, these great market minds. Just so cocky that you could wake up one day and say to yourself, you know, I want to make 2 to 3% per month. Whether it's logical or illogical, they don't seem to think that way. They just come up with the demand. Whereas, like what I just read on not having to play every hand, you're better off to know that the world doesn't work that way. The world doesn't care about you. The world doesn't know you. The world will march on long after we are all gone. So the trick is to find the opportunity where the wind is at our sails. The momentum is rolling our way. Can we predict that? Not exactly. That's the nice way to say it. Can we predict that? No, we can't. Is Twitter filled with so-called brilliant market minds who have something to say every day? Every damn day they got something to say. They are the one with the crystal ball. They are the oracle who can get you there. Listen to them and they can give you all this analysis. And the analysis will do what? Tell you when to buy and tell you when to sell? If someone gives you a market opinion and it's beyond here's where you buy and here's where you sell, which can be measured because look, somebody can tell you where to buy and where to sell and they don't know what the hell they're talking about. Somebody else can tell you where to buy and sell and the evidence shows, well, they actually have a system. They have an approach. They know what's going on, or at least they have a better idea of what's going on than the other guy who's just guessing. But there's the whole other class of brilliant mind on Twitter who just have analysis. They are so smart because they understand how the system works. They know about the intricacies of Goldman Sachs' next step. They know how the Fed thinks. They get it all. Give me a fucking break. That's not how the best traders trade. It's not. Jim Simons doesn't operate like that. Jim Simons says, where's the data? And let me find an edge in the data. Just like these excerpts that I'm reading from Howard Marks. Finding an edge in gambling is the same kind of mentality as finding an edge in investing. Back to the Howard Marks excerpts. The importance of not just winning and losing, but of maximizing wins and minimizing losses. The key is to bet big when you have a big edge and small when you have less of an edge, and to know the difference. As Charlie Munger puts it, the wise ones bet heavily when the world offers them that opportunity. They bet big when they have the odds, and the rest of the time they don't. It's just that simple, end quote. Everyone will have both winners and losers. Various factors will determine the ratio. But the ability to assess propositions can enable you to win more on your winners than you lose on your losers. The size of your bet should take into account both the probability you are correct about who's going to win and the asymmetry of the potential payout. Getting your money in when you have a great hand is one of the most important keys to winning at poker. You don't get many great hands, so when you do, you have to be sure to take maximum advantage. Now look at our current situation right now. Coronavirus coursing through the veins, literally, of the world's population. What does that mean? I don't know. You don't know. Now I can observe, for example, in the last week in Southeast Asia, no commerce, very little economic activity. Airports dead, planes empty. What does this mean? I don't know. It means in the short term, there's less economic activity. Now, I can also look at Japan. Japan has now come out and said, avoid trains, avoid large groups. Well, that's an interesting thing to say when you're hosting the Olympics in a couple months. What does this mean? I don't know. But it does say that it's not normal. Like, we can at least draw that conclusion. Coronavirus is not normal. There's a lot of extenuating circumstances right now. People are getting sick. People are dying. What does that mean for the markets? I don't know. Here's what I do know. Are you ready? Are you ready with dry powder to take advantage of unforeseen momentum in the markets that could spill out because of Corona? That's the thinking. That's the way you should be thinking about what's going on right now. Are you ready? Are you prepared? That doesn't mean you're making a damn prediction. It just means you've got a plan. You've got a process in place. You're ready to take action. Back to Mark's memo. Being able to make it through downturns. It's important to have discipline when risking your capital so that you can survive unfavorable periods and still be around when the winners show up. You have to avoid the risk of ruin, and this requires solid discipline. You must never forget the 6-foot-tall man who drowned crossing the river that was 5 foot deep on average. To that end, good play isn't just a function of relying on the expected value of your holdings and pure math, but also of thinking broadly about risk. The next Mark's point, adjusting your play based on the environment. In poker, if your competition is weak, you may decide to play more hands regardless of their strength and bet more aggressively. While against strong players, you may tighten up and only play premium hands. This is just risk management 101. You've got to have a plan for what volatility looks like, for example. If the markets are generally less volatile, and I'm generalizing there when I say the markets, let's assume a diversified portfolio. But when the markets are less volatile, generally, you can take more risk. When the markets are more volatile, generally, you will take less risk. This should be foundational to your thinking. You are not in this because of ego. You are in this to survive, to live to play another day. That's what you want. The next Mark's point, overcoming emotions and biases. Human failings can cause gamblers to chase in poker, overstay in a hand in the hope of getting a lucky card, play loose, bet too much when they're steaming, smarting from losses and thus driven by heated emotion, and take bad doubles in backgammon. Hope, emotion, and optimism are the gambler's enemies. They're also the investor's enemies, the trader's enemy, the trend follower's enemy. I mean, we can all sit around in a very big picture philosophical way and say that we hope for a positive outcome. But don't bet on hope. Don't trade on hope. That's just your own brainstem churning along. Not so wisely either. A final point from Mark's writing. Second level thinking. It's not just how good your hand is, there's much more. How good does your opponent think your hand is? How good do you think your opponent's hand is? How good does he think you think his is? How is that motivating his actions? The consistent winner has to be able to think at a higher, more complex level than the rest. Now, I think that does apply less in the game of trading. Because as a trend following trader, your opponent is really just you. You're the person that has to play the game. You're not really sitting there looking like in a poker match. You're not really sitting there looking across the table at anybody. You just have a portfolio and you're waiting and you're looking to take action. You really can't know anything about your opponents because it's all embedded in the market price. So there's no doubt there are fantastic parallels between gambling and investing. And Marks does an awesome job across his memos of always outlining these connections. And if you've not seen a Howard Marks memo, there must be something wrong with you. Really? What's going on? I want to take one more thing from Marks' most recent memo. He talks about a book, Decisions Under Uncertainty. He read this book 56 years ago. Now, of course, this happens to be one of those very rare books, so if you go on Amazon, it's probably priced at $1,000 right now. Pulling from this book, Marks gives some great bullets. You have to be able to understand which companies or assets are favored and the attractiveness of the proposition. Now, he's going to have a mechanical way of doing that. That's not seat of your pants. That's formulaic. That's process driven. His next bullet, you need a sense for whether your holding is a good one and for the chance the competition in the market, which you're playing against, might have better. Now, again, from a trend following perspective, it's all embedded in the price. We can't know what someone else is doing. So why entertain it? Why try to guess? Probably better to stick with it's all embedded in the price and follow along with a momentum mindset. Mark's next bullet. You need the discipline to follow a process and the wisdom to accept that no process is sure to produce good results. That we can all agree with, I hope. Process versus outcome. If you are sitting there, like I mentioned earlier in this podcast, hoping, pining for 2 to 3% per month, you want the outcome versus understanding if you have a good process, you can't guarantee the damn outcome. Now, sometimes when I try to explain that to new people, I can tell they think I'm crazy. They think I'm wrong. You can just feel it. They know deep down that guy must be completely crazy. He doesn't get this. He doesn't understand what I want. Oh, I get what you want. And what you want doesn't exist. Back to Mark's bullets. You have to understand the significance of the information you have as well as that which you don't have. You need the nerve to bet heavily based on what you think you know and a healthy respect for what you may not know. Now, again, that kind of a statement has to be reduced to code, to a formula. You have to have a way to assess risk, measure risk, and bet on momentum. And the whole time, have an exit strategy. Mark's last memo, quoting from Jack Grayson's book, Decisions Under Uncertainty. You need to control greed and fear, hopefulness and despondency. You have to resist making an unwise bet just because it could enable you to catch up with the indices or the competition. This is like basic biblical stuff, could I say? Don't covet your neighbor. Don't care about your neighbor. Really, I think it's damn amazing that Michael Bloomberg has made $55 billion. But if anybody who has not made $55 billion allows their mind to focus on Bloomberg's success with a twinge of jealousy or envy, what's the point? That does you no good. You got to do your own thing and let the chips fall where they may. And if you do your own thing and you truly believe in yourself, and if you accept so many of these principles, ideas, concepts, philosophies that I've talked about today, you could have an amazing life.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.